Hey everybody, it's Doug Shoemaker with the Shoemaker Loan Team at Homestead Financial Mortgage, and welcome back to 1 Minute Monday. I've been in the mortgage industry for over 25 years now, and if there's one thing that never changes, it's how overwhelming all the data can be when you're buying or refinancing your home, especially if it's your first time, and especially if you're paying a lot of attention to the headlines. So each week, I take the complexities of the market, rates, affordability, housing, and I break it down in a way that fits how you consume it best. So whether you're somebody who just wants to know what time it is, you kind of like to understand how the clock works a little bit, or you're a true clock builder and you just have to know how everything works, I've got something for each one of you here today. Now we're going to go ahead and start the first minute or so for my friends that just want to know what time it is. According to Mortgage News Daily, national average mortgage rates, they were 6.41 on the 30-year fixed rate, 6% on the 15-year fixed, 5.92 on the 30-year FHA, and 5.95 on the 30-year VA. Now remember everybody, these are national averages. They are not personal rate quotes. Your personal rate, it's going to depend on your credit score, your equity or down payment, the type of loan you're doing, whether or not you're going to live in the home, whether somebody convinces you to pay discount points that you probably shouldn't right now. All those things make a big impact. So what does all the data mean for this week? Well, buyers still have some leverage and inventory is actually improving a little bit. And for those of you who actually bought in the last 12 to maybe 36 months, we're getting closer to refinance territory once again, depending, of course, on your interest rate and loan size. Now, here's the headline for this week. Inflation came in hot. Oil prices are up because of the situation involving Iran, and mortgage rates, they're kind of stuck in the middle, trying to figure out what matters more, inflation or a slowing economy. Now, if you just wanted to know what time it is, your work here is done. And if this information helped you at all, please like, subscribe, and share it with somebody else that's just trying to make sense of this kind of crazy market that we're in. Now, let's go ahead and talk about how the clock actually works. The first big story this week was inflation. And the Consumer Price Index, or CPI, it's basically the government's report card on how fast everyday prices are rising. It actually jumped 0.9% for the month and 3.3% year over year. And that's a big move, but the real story is why. A lot of that increase actually came from energy, oil and gas that's tied to the situation with Iran. Now, if we look at core inflation, which actually strips out food and energy prices, so it can kind of show an underlying trend, it was a lot more controlled. And that matters because this is not broad demand-driven inflation. This is more of an external shock. Then over the weekend, talks with Iran seemed to kind of fail. The Strait of Hormuz remained effectively blocked, and the U.S. then moved to restrict Iranian oil exports, and that's a really big deal because it threatens supply, and it actually keeps pressure on oil prices. And normally, that would push mortgage rates much higher and quick, but bonds have actually been pretty resilient, and that's your clue. The market seems actually more concerned that higher energy prices are going to slow the economy than it is about the long-term runaway inflation that it had been so afraid of before. Now, let's go ahead and bring in housing information. Existing home sales actually fell 3.6% in March to an annual pace of 3.98 million. Now, inventory rose to 4.1 months of supply. That's better, but it's still below a balanced market. And at the same time, the median home price actually hit $408,800. That's a record for March. So even though sales slowed, prices are still climbing. And that's another reminder that waiting for a crash, it's just not been a winning strategy for anybody. Now, we also got a terrible consumer confidence number. The University of Michigan Consumer Sentiment Index, which actually measures how confident people feel about their finances and the economy, well, it fell to 4.76%, and that's the lowest since the 1970s. People are feeling it. Higher gas prices, economic uncertainty, income concerns, and that all matters because when confidence drops, so does spending. And when spending drops, growth slows, and inflation pressure usually follows. Now, let's go ahead and talk about the technicals for just a moment. Mortgage bonds, they're actually sitting right on their 200-day moving average, and that's always a major decision point. Now, if bonds break higher from here, rates are going to improve. If they fail, we could see rates move up once again. Now, the 10-year Treasury, it also is fighting around 4.33%. If yields break above that, things could worsen pretty darn quick. But if they stay below it, that'll actually be supportive of better mortgage pricing. So this week, technicals do really matter. And a few of the other things that I'm actually watching are Tuesday has the producer price index or PPI, and that actually measures inflation at the wholesale level. So it's what businesses are paying before the product actually hits you. Now, Wednesday, we've got mortgage applications, housing data, and the Fed's Beige Book. And the Beige Book is basically a real world check in on how the economy is actually performing. Thursday, we've got jobless claims plus industrial production and capacity utilization. And those two things actually show how much we're producing and then how much of our actual capacity are we using. What the market's actually trying to figure out right now is really simple. Is inflation going to stay sticky, or is the economy slowing enough to actually bring rates back down later? Now, for my clock builders, this week is a perfect example of something I've been teaching. Not all inflation's created equal. So there's something called demand-driven inflation, and that's basically when the economy is rocking. Wages are rising, people are spending like crazy, and prices keep on climbing. That's the kind of inflation that actually keeps rates high. Then there's something called shock-driven inflation. Now, that's what we're actually seeing now. Oil spikes, we have war, we have supply issues. Prices go up, but not because things are strong. They're going up because something's broken. And that kind of inflation can actually slow the economy down. Why? Well, because higher gas prices, they act pretty much like a tax. The more you spend at the pump, the less you spend everywhere else. That's why this week really matters. Inflation's rising, but growth is slowing and confidence is dropping. In the bond market, it's already asking, hey, what happens next? And if this slows the economy enough, rates may actually improve later, even though today's inflation looks pretty darn ugly. That's next level understanding. Rates don't just react to inflation, they react to what inflation is going to do next. So what should you do with all this? Well, if you're buying, strategy matters more than speed right now. If you bought in the last couple years or 3 years, you want to stay alert. If rates improve by even a half or 0.75%, depending on your loan size, it might be time to act because the last 2 or 3 times we saw that kind of a rate dip, it didn't stick around for more than a day or two. Now, if you're trying to time the market perfectly, just remember, almost nobody gets that right. A good plan beats a lucky guess every single time. And at the end of the day, this market's being pulled in multiple directions, and that creates opportunity for people who understand how it works. Now, if you want help building a strategy around your personal situation, reach out. No pressure, no spam, just guidance. Now, we can even set something for you called a strike rate if you're a current homeowner so that when the market gets where it needs to be without you paying discount points, we'll actually notify you through a home report. Now, home report's a free tool that I provide for you. You can see the link down in the description. It's going to give you great data on your home, your community, what you can do with your equity. And as I said, we'll be able to notify you through there when the market hits a certain point that we've established that you need to start thinking about pulling the trigger. It's great data and no spam. And as always, I hope I can count on you guys to support the Home Foundation, where we're helping make our local heroes homeownership more affordable. So for our military, law enforcement, firefighters, and their family, scan the QR code to learn more or make a donation. Thanks for watching. And if you got any questions or you want a second opinion on your current loan estimate, make sure and reach out. We're here to help. Have a great week, and I'll see you next week on 1 Minute Monday.